They say the market has stabilized. They say the storm has passed. They say silver AES violent swings were a speculative excess, a temporary mania that burned too hot and finally exhausted itself. They want you to believe the market has found balance. They want you comfortable. They want you calm. But calm is exactly what you should not be. It is Wednesday, February 11th, 2026. Gold trades at $5,070 per ounce. Silver trades at 85.15s. At first glance, those numbers look strong. They look elevated. They look like the result of a completed bull run. Many investors see those prices and assume the move has already happened. But what if these prices are not the peak? What if they are the calm before a repricing event that resets the entire monetary system? Because beneath the surface of this market, beneath the daily candles, the headlines, the reassuring commentary, something far more powerful is unfolding. The battle for silver is not over. It has only evolved. And the most dangerous phase of any market cycle is not the crash. It is the illusion of stability. The illusion of normality. Look at silver's recent price action. It bounced from $121 down into the $72–80 range. Now it trades near $85. To most traders, that looks like consolidation, a healthy correction, a sideways channel. Your brain wants to interpret that as safety. You see a range, you see structure, you assume you have time to wait, time to buy lower, time to see what happens. But the appearance of a trading range can mask a structural imbalance. While the paper price oscillates, physical metal is being absorbed. Inventories are not growing. They are shrinking. Vault reports show consistent drawdowns. Delivery requests continue. The divergence between paper claims and physical availability quietly widens. And this is how major repricing events form. Not with panic, but with quiet accumulation beneath surface calm. The arithmetic that changes everything. Let S step back from silver and examine the larger monetary picture, because gold is the anchor that defines silver's trajectory. A research firm recently approached the gold market not with optimism or emotion, but with arithmetic. They asked a simple question. If the Federal Reserve needed to restore balance sheet credibility in a crisis, what gold price would be required to back its liabilities at historical precedent levels? Throughout monetary history, when fiat systems approach instability, central banks restore confidence by partially backing their currency with hard assets. Not 100%. That would freeze the system. But historically between 33% and 50%. Now apply that formula to today, the Federal Reserve's liabilities, currency in circulation, reserves, reverse repos, and other obligations. Measure in the trillions. Divide those liabilities by the total ounces of gold officially held. The result? To achieve 33% backing, gold would need to trade near $8,000 per ounce. To achieve 50% backing, gold would need to trade closer to $12,000. This is not a prediction. It is a ratio. Liabilities divided by ounces equals required price. At $5,070, gold is not historically expensive. In a currency reset scenario, it may be dramatically undervalued relative to its potential systemic function. The Federal Reserve's structural trap. Why would such a reset even be discussed? Because the Federal Reserve faces a structural problem that cannot be solved with conventional policy tools. During crises, financial collapse, pandemic stimulus, emergency liquidity programs, the Fed created trillions of dollars. Those dollars now exist as bank reserves. To prevent those reserves from flooding into the economy and igniting uncontrolled inflation, the Fed pays interest on them. That interest rate sits around 5%. But the bonds the Fed purchased years ago yield closer to 2%. They are paying 5%. They are earning 2%. That 3% negative spread across trillions results in annual losses approaching $250 billion. $245 billion per year. Raise rates. Losses expand further, and the federal government's debt servicing burden explodes. Cut rates. Inflation risks reignite, and bond markets destabilize. The Fed is not omnipotent. It is constrained by arithmetic. And arithmetic has no political loyalty. Silver's short structure. Now return to silver, because while gold reflects macro pressure, silver reflects tactical warfare. Futures positioning reveals a significant short interest, roughly 30,000 contracts, representing about 150 million ounces. That is 450 tons of silver represented on paper. Short selling is not inherently malicious. It is part of markets. But when leverage builds and physical inventories decline simultaneously, risk concentrates. If price falls, shorts profit. If price stabilizes or rises, shorts must eventually buy back contracts to close positions. That buying can accelerate price movement. When silver tested 80.75 and rebounded sharply to 85.15, a 5.5% single-session rally, it demonstrated something critical. There is buying pressure beneath the market. That is not the behavior of a collapsing asset. It is the behavior of an asset with underlying demand. Physical demand is not theoretical. In January alone, Turkey imported approximately 273 tons of silver, nearly 8.8 million ounces in 1 month. That is more than 1% of global annual mine production absorbed by a single country in 31 days. This is not speculative trading. This is physical accumulation. And Turkey is not alone. Emerging markets understand currency instability firsthand. Their demand for tangible assets is not ideological. It is experiential. When local currencies weaken, hard assets become survival tools. Silver, unlike gold, straddles two worlds: monetary hedge, industrial input, solar panels, electronics, defense systems, EV components. Silver demand is structurally embedded in modern infrastructure. This dual demand base makes silver uniquely sensitive to supply disruptions. Supply is not infinite. Mining production does not surge on command. Silver is often produced as a byproduct of other metals. When base metal production slows due to economic contraction, silver supply can contract even if silver demand rises. Add geopolitical export controls, regional stockpiling, and logistical friction, and available Western inventory can tighten quickly. Paper contracts can be created instantly. Physical ounces cannot. This difference between derivative liquidity and atomic scarcity is where stress accumulates. The liquidity window. We are entering a period where Asian markets reduce participation during Lunar New Year. Lower participation creates thinner liquidity. In thin markets, price moves can become exaggerated. Small sell orders can trigger outsized moves. Algorithms can exploit stop-loss clusters. Volatility increases. But volatility in thin markets is not equivalent to structural weakness. If silver drifts towards $72 during low liquidity conditions but rebounds quickly, it confirms demand strength. If $80 continues to hold despite reduced Asian participation, it signals resilience. Thin markets amplify emotion. They do not redefine fundamentals. Psychological warfare markets are psychological battlegrounds. The goal of volatility is often to exhaust conviction. If price dips in a holiday-thinned environment, headlines will frame it as breakdown. Commentators will declare trend reversal. Retail participants will hesitate. But structural imbalances do not resolve because of one thin week. They resolve because supply and demand eventually collide. Connecting the dots, let's synthesize. Gold may require $8,000 to $12,000 in an extreme recapitalization scenario. The Federal Reserve is constrained by negative carry dynamics. Silver carries significant short interest. Physical demand from sovereign and industrial buyers is absorbing supply. Mining growth is limited. Geopolitical supply chains are tightening. Liquidity will temporarily thin. These are not isolated events. They are converging pressures. What happens in repricing? Cycles. Repricing events rarely occur gradually. They build tension quietly. Then they move violently. When shorts are forced to cover, buying accelerates price. When price accelerates, more shorts cover. When physical buyers compete with forced covering, Volatility intensifies. This is not guaranteed, but it is structurally possible, and markets often transition from range-bound boredom to vertical panic faster than consensus expects. Perspective matters. At $85 silver and $5,070 gold, many believe they are late. But if gold reprices toward even the lower bound of historical backing ratios, silver does not remain static. Historically, silver moves more violently than gold during monetary expansions. The gold-to-silver ratio fluctuates widely during stress periods. If gold rises substantially, silver's percentage move can exceed it. The question is not whether volatility will occur. The question is direction over multi-year horizons. Final reflection. We are not observing a stable plateau. We are observing compression, a market balancing leveraged short exposure against accelerating physical accumulation, a monetary system balancing negative carry losses against inflation risk, a global economy balancing debt expansion against currency confidence. Compression precedes release. The illusion of normality precedes repricing. Short-term volatility may test conviction, but structural forces operate beyond weekly candles. The window for strategic positioning is always before recognition becomes universal. Because once repricing becomes consensus, the opportunity phase is over. The floor near $80 has been defended. The macro backdrop favors tangible assets. Liquidity events may create noise, but noise is not trend. The system is under strain. Arithmetic is uncompromising, and markets eventually resolve imbalances, not gradually, but decisively. The choice, as always, belongs to the participant. Prepare early or react late. History shows which approach tends to win. They keep telling you the volatility is over. They say the market has stabilized. They claim silver's violent swings were just a speculative phase that has now burned out. That narrative is false. It's Wednesday, February 11th, 2026. Gold is trading at $5,070 per ounce. Silver sits at 85.15s. If you believe these prices represent equilibrium, if you think we've reached some natural balance, you are missing what's happening beneath the surface. The battle for silver isn't over. It has entered a far more dangerous phase. This time, the weapon isn't a crash. It's the illusion of normality. Silver bouncing between $72 and $85 looks like a range. It feels predictable. It convinces you that you have time. Time to wait. Time to analyze. Time to buy later. That belief is the trap. Because while traders watch candles move sideways, physical metal is quietly disappearing. Vault inventories are being drained. The gap between paper pricing and real-world demand is widening. And when that gap finally snaps, it won't be gradual. Now, let's talk about gold. Because gold explains everything. A research firm, Mkin Capital, recently published a simple but devastating calculation. They didn't ask where gold might go. They asked where gold must go. Throughout monetary history, when fiat systems reach the breaking point, central banks restore credibility by backing their liabilities with hard assets. Not 100%, but historically between 33% and 50%. Apply that formula to the Federal Reserve's balance sheet today. If 33% backing is required, gold needs to trade near $8,000 per ounce. If 50% backing is required, gold must trade closer to $12,000. That isn't hype, it's arithmetic. Total liabilities, total gold reserves, required gold price. At $5,070, gold isn't expensive. It's potentially trading at a 50% discount to its systemic utility value in a reset scenario. Why would such a reset even be necessary? Because the Federal Reserve is trapped. It created trillions during crises. Those reserves now require interest payments around 5%. But the bonds the Fed holds yield closer to 2%. They are paying 5 and earning 2. That negative spread across trillions equals roughly $245 billion in annual losses. Raise rates. Losses explode and debt servicing becomes unsustainable. Cut rates. Inflation accelerates and bond markets destabilize. There is no painless path. The only structural solution left in extreme scenarios is revaluation, repricing gold higher to strengthen the balance sheet. That's the macro backdrop. Now let's zoom into silver, where the tension is even more immediate. Silver's fall from $121 into the $72.80 range was framed as a healthy correction. But positioning data tells a more complex story. A massive short position, roughly 30,000 contracts, equivalent to about 150 million ounces, has been built in the futures market. That's 450 tons of silver represented on paper. Short sellers can profit while prices fall. But if price stabilizes or rises, they must eventually buy back those contracts. And if they are forced to buy in size, the act of covering becomes fuel for a rally. This is the mechanics of a short squeeze. And here's where it gets critical. Silver tested $80.75. It immediately rebounded and closed at $85.15. A sharp 5.5% recovery. That's not weak price action. That's a defended floor. If silver pushes toward $90, leveraged shorts begin to feel pressure. Margin calls force buying. Buying pushes price higher. Higher price triggers more covering. Feedback loop. Now add physical demand. In January alone, Turkey imported approximately 273 tons of silver, nearly 8.8 million ounces in 1 month. That's more than 1% of annual global mine supply absorbed by a single country in 31 days. This isn't speculative flipping, it's accumulation. Meanwhile, geopolitical tensions have tightened supply chains. Export controls from major producing regions restrict flow. Western vault inventories are declining. Paper contracts can be created instantly. Physical metal cannot. That difference is everything. Now we approach what I call the liquidity window. During major Asian holidays, especially Lunar New Year, regional exchanges reduce activity. Liquidity thins. In thin markets, price can move more aggressively on smaller volume. That environment creates volatility. It does not change fundamentals. If silver drifts towards $72 in low liquidity conditions, it may feel like weakness. But if buyers step in again, if $72 holds and price rebounds, it confirms strength. And if silver remains above $80 through a thin liquidity period, the pressure on shorts increases dramatically once full global participation returns. So let's connect the dots. Gold may require $8,000 and $12,000 in an extreme balance sheet reset scenario. The Federal Reserve is structurally squeezed by interest rate math. Silver has a large short position that could become unstable if price rises. Sovereign and industrial buyers are absorbing physical supply aggressively. Supply chains are tightening. This is not a typical market environment. It's a market where structural pressure is building beneath surface calm. Is volatility possible in the coming days? Absolutely. Is that the same as collapse? No. Price swings in thin markets can distort perception, but perception and fundamentals are not the same thing. At 85 times silver and $5,070 gold, we are not looking at parabolic excess, we are looking at tension. The floor around $80 is being tested. The macro backdrop favors hard assets. Liquidity events may create noise,